A lot of people believe that bonds are more attractive than equities right now. We're just talking about the 2-year trading at a high we haven't seen since basically the Great Recession, about 16 years. Is that changing how you're balancing portfolios, especially after we see the 60-40 portfolio coming off its worst year since 1999?
It has changed things a bit. You're right. There's a lot more yield to be had on the fixed income side. Much easier to pick up decent rates of interest and not taking a lot of credit risk or duration risk. And so that makes things much more compelling. I don't think the picture has changed a whole lot on the equity side, particularly as you look out over a longer time horizon. The short term here we think will be volatile, but we do think there are gains to be had on the equity side as well. So it does change the picture somewhat. And I think both sides of the 60-40 look reasonably compelling here over a reasonable time horizon.
All right, let's focus on the 60% part. That's equities. Tech's shown a lot of leadership this year. There's been some questions about the quality of that leadership, but tech stocks, big mega cap tech, cloud stocks, just across the board, high risk assets have risen even as interest rates have risen. What do you make of that? Do you expect to see in this last month of the first quarter any change of leadership?
I think leadership will remain the same. And I think February has brought us some really interesting clues. As you mentioned, rates have gone higher and tech's remained in leadership, and some of the areas lagging have remained the same as well. And what that tells me is that the market has done a pretty good job in terms of digesting the higher part of higher interest rates, which was really affecting the tech sector. But it's still coming to terms with the longer portion of higher for longer. So I think that timeline is still in question for how long it will take to get inflation fully under control. But I think we're sort of past the concerns about the peak going too high. And that tells me that we're in a mode where things will stay the same. This sector leadership will remain in place. And over a long time horizon, we'll fight our way through this inflation battle.
All right, speaking of inflation, February has just been marked by volatility. We have some big reports coming up in the next few weeks. We have CPI coming up in the middle of the month. Then we have the Fed meeting and then the Fed minutes at the tail end of the month. What do you make of all this? How much do you see this move in the market? Or is the idea of rate hikes and the fact that we're going to have higher inflation just already priced in?
Well, I think we're back to a very highly news-dependent take on each of the inflation metrics. So we went back and looked at the last 12 or 13 readings that have come out on different inflationary metrics. And one of the things that we've noticed is that it's not been so much about the level that's come out. It's been more about how have the numbers come in versus expectations. So this is the way we were maybe 18 months ago. For a long time, that faded and things were just sort of generally assumed to be getting better. Now we're back into a mode where it's all about how those figures come in versus expectations. So I think that sets us up for some volatility here as we work our way through all those critical announcements that you referred to.